think of all the times I've spoken at your events, this is definitely the time when I can sound the most excited about the opportunities for bond investors. So as Dan said in the introduction, I'm the lead fund manager of Invesco Bond Income Plus. That is an investment trust with the ticker of BIPS in the London Stock Exchange. I'll refer to the fund as BIPS throughout. If you've seen me present before on the AJ Bell platform, the presentation is different today, but the title, Delivering a Steady Income in an Uncertain World, it's actually the same one we've used for the past few years. So I did want to change it to something snazzy like The Return of Income or Income is Back, but my colleague who puts the slides together reminded me that really steady income is exactly what the trust has done, and it continues to do so. So we decided to stick with that, because you'll hear income is definitely back for bonds right now. So I have to pause on this page for compliance purposes, just to remind everyone there are risks to investing, and these risks can be found on the BIPS website. Moving on. My background is as a credit analyst, so that's the bond equivalent of an equity analyst, but unlike an equity analyst who's always looking for a company's story, as credit analysts, we worry about the credit risks of lending to that company, and that's really important, I think, in this environment as well. I also manage our monthly income plus fund, which is a £2 billion open-ended fund with a similar income focus to BIPS, but managed in a different way. So for the next 20 minutes or so, I'm going to talk about bonds. BIPS is an income fund. It's very much focused on high income bonds to achieve the dividend target that we have on the trust, which is 11.5p per annum. Then I'll talk about the market. As Dan said, last year it was tough for bonds, but that leaves us with a good starting point of high yields this year. I'll also talk about how today, with that, bonds can offer some potential for capital appreciation as well as income, and then I'll move on to the fund itself. So first of all, why are bonds considered so useful when we want that steady, reliable income? And this is relevant kind of throughout the presentation. The main point is, compared to equities, a bond pays this agreed rate of interest every year. We call that the coupon. It's a contractual obligation, unlike a dividend on an equity. And then the second point really is around ranking. So a bond is simply a loan to a company or a government. And because of that, it ranks above an equity if things go wrong in the business. The trade-off is the upside on a bond is more limited, whereas equities, of course, offer an unlimited upside. All of which I think gives equities and bonds a different appeal for different part of your portfolio. So with that in mind, obviously, not all bonds carry the same level of risk. And as bond investors, we categorize bonds according to their level of credit risk, meaning the credit risk in lending to that borrower. So in other words, what are the chances of me not getting my money back from company X? So the rating agencies, and you can see on this page the credit ratings that they produce, they simply rank that credit risk from extremely low, AAA rated, to be careful, CCC rated. You'll hear me refer to some of those ratings during the presentation, and then those get split into these two broad groups, which is investment grade, anything that is rated above that dashed line. So anything rated above BB, and anything rated BB and below is called high yield. Obviously, as the bond you move down the risk spectrum, the yield that you can earn on bonds increases, meaning a single B-rated bond typically yields more than a BB, etc. So it's actually the rating that defines whether a bond is called high yield. And for a long time, central banks putting liquidity into markets for so many years, especially in the past decade, high yield bonds have really not been very high yielding. That has now really changed. So we had a repricing last year in the bond market. In Europe, the high yield index currently yields around 7.7% on a yield to maturity basis. At the start of 2022, that was 3.4%. So a very quick note on the terminology we use, because I know not everyone is familiar with this, but when we talk about yield to maturity, that is the income yield that a bond makes plus any movement in price as it returns back to par. So bonds are issued at the start of their life at a price of par, or 100, and they're repaid at that price, par at maturity. And then for reference, the average yield to maturity on the BIPS portfolio, so that's the income yield plus the potential for capital appreciation back to par. It's just over 9% at the moment, and then we use gearing to enhance that further. On this page, we've added this slide in to talk a little more around subordinated bonds, given what has just happened with Credit Suisse and their additional tier 1 bonds, or bank CoCos, as they're also referred to. So in addition, within the portfolio to investing in traditional high yield investment grade corporate bonds, we do also invest in a category of bonds that are referred to as subordinated bonds. So this is where additional tier 1 bonds, all bank CoCos as they're called, fit in. That terminology is in a lot more people's vocabulary now after the events with Credit Suisse this year. By subordinated, this means that they are the lowest rung of debt in the structure, and you can see on this page they sit in that layer above equity in each of these cases. There is some misconception around the risks associated with subordinated bonds. They can be high yield rated, they can be investment grade rated, and typically, despite their description, they are rated as better credit quality compared to the wider high yield bond market. But it's the terms of these bonds that do often mean that they often have less protection if things do go wrong. So that's when we need to be really careful as investors with subordinated bonds. So for us, when we do invest in them, making sure the portfolio is comprised of a good mixture of different companies, banks, insurance companies, that's very important when investing in this space. And they do offer some very attractive levels of income. So for example, Lloyds Bank has an investment grade rated, good credit quality rated CoCo bond yielding around 9% per annum. A lot of the subordinated insurance bonds that are within the trust are typically rated investment grade. And similarly for corporate hybrids, which are often issued by investment grade rated companies like Volkswagen, Vodafone, National Grid. So household names that people would be familiar with. So subordinated bonds are another place we can find higher yields alongside traditional high yield bonds. It's not mandated in the trust. The level, the level of which we can invest in that part of the market, but the range is normally around 20 to 30% of the portfolio. And the key for us, as I mentioned, it really is diversification. So if I take that exposure to CoCos in the fund, that is spread across 25 different banks within the portfolio. So how about some examples of bonds that BIPS invests in, just to make it a little more real for people. As I said, typically high yield rated, but we do invest in some investment grade rated as well. The focus is on traditional high yield corporate bonds, and then, as I mentioned, also some subordinated bonds. On this page, on the left-hand side, Ford, high yield corporate bond issuer. Ford used to be investment grade, it's now high yield. When a company does drop from one to the other, we refer to that as a fallen angel. That happened to Ford during COVID. It's still rated BB, so that's at the upper quality end of high yield, just below investment grade rated. For us as a team with a lot of experience investing in high yield bonds, Ford dropping down to high yield was actually very exciting. And they recently issued a bond with a coupon of 6.86%, slightly unusual number, but 6.86%, maturing in 2026. And we certainly viewed that as very attractive to be able to put into our income portfolios like this one. Teva, which is the world's largest manufacturer of generic drugs, it is now firmly a high yield bond issuer. It lost its investment grade rating about 6 years ago. But again, it's a high quality, high yield issuer with a BB rating, aspirations to become investment grade rated again one day. And they recently issued a dollar bond with a coupon of over 8%. For us, again, very attractive for the credit risks investing in that company. On this page, companies where we own the subordinated bonds. I've mentioned Lloyds Bank. They have bonds with a yield of around 9%. BNP Paribas, again, a very good quality bank with yields of similar levels. Also National Grid in the UK. So Lloyds and BNP's bonds are investment grade rated, whilst National Grid's bonds are at the upper end of that high yield rating. If we're talking about more traditional high yield bonds, so those sitting a little further down the rating spectrum, I've included Italmatch on this page. It is rated single B because of the risks around the cyclicality of its business. It's a chemicals manufacturer. But because of that rating, because of what it is, it's also paying a very appealing 10% coupon. Again, very attractive for an income portfolio. So the portfolio is built up with bonds from lots of different companies like these. Crucially, companies that we can rely on to keep paying those coupons. Then those coupons can be paid out by BIPs as income to shareholders on a quarterly basis. Of course, it's never as straightforward as that all the time. Sometimes companies do fail on that contractual obligation. Pizza Express is on this page. Although the business is still operating, they did have to restructure their balance sheet in 2020 because they could no longer afford their debt. So investors in their junior bond, it was a £200 million junior bond, were essentially wiped out. Their claim was worthless. Whereas senior bondholders walked away as the new shareholders. So if you own those junior bonds in Pizza Express, it was a very bad outcome. Since then, Pizza Express has returned to the home market, much lower debt burden, and we were happy to lend to them again. So as high yield fund managers, there are some ways, two very important ways, in fact, that we handle the credit risks of the companies that we invest in. The first is we have a team of very experienced credit analysts. So they spend every day reassessing the credit risks of the companies whose bonds we own. So for example, our view of old Pizza Express was the company had heightened credit risks before the pandemic, and so we'd already sold those bonds. The second way that we manage those risks is through diversification. And by that, I mean BIPs will typically have bonds from well over 100 different companies. So if we do have a Pizza Express in the portfolio, the damage is somewhat mitigated by the fact that it's a diversified portfolio. It's a different way of constructing a portfolio than you would with equities, simply because equities and bonds have those different return profiles, an unlimited upside for equities, more limited on bonds, going back to that earlier slide that I discussed. So moving on to the market, this chart is the yield on the European high yield bond market. It's been several years now since we've seen yields like this in our markets. And if you put that brief sell-off during 2020 to one side, it's been about a decade since we've last seen these kinds of yields. So what happened last year to change things so much? Well, Dan spoke about it before, but inflation, the nemesis of bonds, was a lot higher than most people had expected. That had coincided with bond yields starting the year at very low levels. Even the high yield bond market in Europe offered an average of only 3.4% yield at the start of 2022. It ended the year at around 8%. That's far more exciting for income investors, but the pain felt by bondholders last year as we moved from low yields to much higher yields, which did mean that bond prices fell. That pain was severe. It shouldn't be played down. The beauty of bonds, however, is they will recover back to that price of par or 100 at their maturity date. So long as the bond issuer does not default, then we know what the end result will be. And the high yield market in Europe started this year at an average price of around 85. So that means we're now in a position where bonds can not only offer a coupon income stream, but also the potential for capital upside over time as they move back towards par. This chart really just shows what I mean when I say 2002 was painful. Virgin Media, good quality high yield bond issuer. This particular bond was trading around 100 or par at the start of 2022 with a yield of around 4.25. To move to a yield today of 8%, it fell 20 points in price to price around 80. Now, of course, that also means that today that bond has the potential to get back to par or 100 at its maturity, whilst paying that income along the way. That pain has also meant that there are a lot more opportunities that have appeared on the market as a result of what happened last year. A couple of examples here on the left-hand side, Verisure. So this is an example of a company that had to issue a bond into that weak market last year. And to get that deal done, they needed to pay a very enticing coupon of 9.25%. Back in 2021, you can see Verisure, which is a Swiss security and alarm company with presence in the UK as well, issued a 6-year bond with a coupon of only 3.25%. So that dramatic increase from being able to borrow at 3.25% to now having to pay a coupon of 9.25% to borrow, that's reflective of the shift from a very low yield environment to what we have today. The exciting part for bond investors is that so long as a company can afford to pay that higher interest cost, then bonds like this are a great source of income generation within the trust going forward. So that is something that we hope to see more of as companies get used to the prospect of having to issue debt with higher borrowing costs. The second example on the right-hand side is Asda. So these were bonds we bought in the secondary market, i.e. they had been issued, they were trading. They were issued with a relatively low coupon of 4.5%, because the market was strong at the time, back in 2021. Last year, we bought those bonds in the market at a price of around 78. So long as Asda does not default and these bonds are repaid at maturity in February 26, that's over 22 points of capital appreciation between now and then. You add on the coupons earned over those few years, and we're talking about a total return profile between now and then of just shy of 50%. And actually, I think that stacks up very well against equities. But we have the benefit of that being a contractual obligation. So Asda must pay bondholders the coupon each year, 4.5% coupon each year, and it must repay bondholders at a price of 100 in February of 26. So although last year was a painful repricing, what it does leave us with today are these types of exciting opportunities in the market. I've touched upon the subject of defaults, and it's a very important factor when investing in the high bond market. It's the reason that we place so much emphasis on our credit analysis, and also why we maintain that good diversification of companies that bonds is invested in. This chart includes forecasts for default rates for Moody's, one of the rating agencies. These forecasts will inevitably be wrong, they always are, and Moody's will update it along the way anyway. But there's a general sense of the direction. I do agree with this chart. Looking forward, with companies facing higher borrowing costs and most likely a weaker economic environment, then broadly speaking, I think it is sensible to expect default rates to be higher than they have for several years. We will need to navigate that environment very carefully as a team, and certainly the portfolio today reflects that more cautious outlook. So that brings me on to an outlook for the markets. High inflation drove markets last year. Central bankers raised rates to try and combat that. Inflation clearly remains a key focus, but the outlook for inflation versus a year ago is much better than it was a year ago. There are risks today around higher borrowing costs, potential for weaker growth. But as I mentioned, there are also some very good opportunities to keep adding income back into the portfolio, which we will continue to do. The nice thing is we don't need to be pursuing the riskiest parts of the market. So as I go back to that one of the slides at the start, so those single Bs, triple C rated bonds, we do own some, but we don't need to be pursuing that part of the market to earn a decent yield. We can earn that from much lower credit quality parts, better credit quality parts of the market. So with that in mind, that outlook in mind, the portfolio is still relatively cautiously positioned. And then the next phase for the market, looking ahead, is ultimately in the long run, which I think would be very good news, is that when high yield bond issuers come back to the market with a new bond going forward, as we saw with the example of Verisure, they will be paying higher coupons to bondholders. That's great news for income investors like BIPs. So the final section, the trust itself, it was formed in 2021 for a combination of two trusts that we've managed for many years on the desk. I've managed both since 2014. The result is the largest investment trust in the AIC loan and bond sector. Diversification, as I mentioned, very important. So right now, the trust owns 178 different issuers, as in different companies, so really spreading that risk around. The trust can borrow. It's a common feature in investment trusts. It's a very important distinguishing feature against our open-ended mutual funds. The ability to use borrowing in a prudent manner, I think, can be a very powerful tool. And essentially, for this fund, the borrowing is used to buy more of the bonds that we like. So it allows BIPs to maintain that attractive level of dividend for shareholders without having to buy the riskiest bonds that are out there to earn that high level of yield. It's something that we have a long track record of doing in the team with the predecessor trusts, and I think 2020 really was as good a test during that real weakness in markets in March and April. It was as good a test as you can get in terms of managing funds with borrowing during a rapidly falling market. Of course, there are stipulated limits in place on borrowing. That's set at 30% of gross asset value. Today, we're at around 17% of net asset value. And then the final point here is on the dividends. So last year, the target dividend was increased again from 11 pence to 11.5 pence per annum. The aim is to give shareholders that clarity around a level of income to expect. So on today's share price, that equates, that 11.5 pence equates to a dividend yield of around 7.1%. That 11.5 pence is more than covered by the income that's being earned in the trust. So there is additional income which is being earned but not being paid out, that's sitting there in the NAV. So to sum up, for BIPs, by carefully choosing the bonds to invest in, using some borrowing, BIPs is able to offer a high level of income to shareholders in this market, in this environment, who are looking for steady income. And then I'll finish here. Finally, this is the team. There's a lot of industry experience. That's the numbers in brackets and some cheery faces. So thank you very much for watching.